Okay, heroes, we're back. We're talking today about trade duration. Now, most people have an understanding that you buy stocks for the long term. Over time, stocks will go up, prices will go up, and you make money. You kind of sit there, you put money in the register, and it gives you back more money at the end of the day. But buy, hope, and pray, as you're starting to realize, is not a strategy. At least for success. It's a strategy for failure, but not for success. So when we talk about all these strategies that you have learned about so far in this Market Hero course, and that you're going to hear about throughout the rest of the course and throughout the rest of your time as a member of Market Hero, it's very, very important that we talk about trade duration. So we don't execute trades for the very, very long run. The probabilities are not on our side. The return on capital are not on our side. And we prefer to maximize those as best as we can, right? So most of the studies, at least all the ones where we're selling options, right? And again, why do we sell options? We sell options because options are priced off of their expected move, and we know that the expected move over time overstates the actual move. And the actual move is what options get their final price off of. Again, so options are overstated and because the expected move is overstated to the actual move, right? And we're trying to maximize that. And one of the things that you have seen and that you will see moving forward is that when we're doing trades, again, the majority of these strategies that you guys are going to see are done in the 50-day window. A lot of people go, Stephen, why do we do these things in the 50-day window, right? Why not 30? Why not 70? Why not 365? Well, we're going to start to dive in and show you exactly why we do this 50-day thing, right? So again, in all the studies you've seen so far and all the studies that you will see moving forward, a lot of them have one thing in common, or excuse me, two things in common. The first thing they have in common is that we are placing these trades in the monthly expiration cycles, right? Let me repeat that. We're placing these trades in the monthly expiration cycles. Now, as you'll notice in the liquidity checklist, one of the things that we check for to make sure a stock is liquid enough for us is that not only does it have the monthly expiration cycles, but it also has weekly expiration cycles. That tells us that there's enough demand to expand to more expiration cycles beyond just the monthly ones, right? But we don't really care about the weeklies. We care about the monthlies because that's where the liquidity is, right? They have the most liquidity. The monthly expiration cycles have the most liquidity. And because of that, we're going to trade in that. Remember, the more liquid the product, the better price you're going to get. The more competitive a product, the more competitive an expiration cycle, like the monthly expiration cycle, at least when we compare it to, say, weeklies or quarterlies, the better price we're going to get, the quicker we're going to get filled. And I don't know about you, but I would always choose to be in the product in the expiration cycle where, number one, I'm going to get filled quicker, and number two, at a better price. Right? So that's one thing all these strategies and all these studies have in common. The second thing they all have in common is that not only are they in the monthly expiration cycles, but they're in the monthly expiration cycle closest to 50 days from expiring. Now, again, you've seen that before, you're going to see that in the future, but let's start to talk about why we are doing that, because the 50-day window is our sweet spot. So the first part, the monthly expiration cycles, right? We trade in the monthly expiration cycles because they have superior liquidity compared to the non-monthly expiration cycles that are like weekly or quarterly. So let's take a look at Apple right now. And I took the screenshot from earlier today. I'm doing this later on in the evening. The markets are not the same in the evening as they are during the day. So I took screenshots of a monthly expiration cycle for Apple. So expiring in 39 days. That is the closest expiration cycle to 50 days. Right? So what you can see here is if you look on the put side, the at the money put has a 1 cent wide spread. It has a ton of open interest and it has a ton of volume, right? The 165 put, 1 penny wide, a ton of open interest, a ton of volume, right? The 160 put, 1 penny wide, right? A ton of open interest, a ton of volume, right? We go to the call side. The 175 call is actually 10 cents wide. That's a little wide, but looking at the 180 call, 4 cents wide. The 185 call, 1 cent wide. The 190 call, 2 cents wide. So this is what liquidity looks like. Remember, we want to see the bid-ask spread under 7 cents. We see that everywhere across the board. We want to see volume in the thousands. We see that not just for the stock of Apple, but we see that for almost every single strike price. And then again, we see open interest in the thousands. And in fact, on the call side, all but one of our strike prices, we see open interest in the tens of thousands, right? So this is what a monthly expiration cycle looks like. Again, we focus on these and these only because they're the most liquid. Now, if we take a look at a weekly expiration cycle, it starts to look a lot different. We see 15 cents wide, 10 cents wide, 8 cents wide, 7 cents wide, 6 cents wide, right? Not only that, but we see volume much, much, much lower than we see in the monthly expiration cycle. And the same thing with open interest, right? And then the call set, 10 cents wide, 10 cents wide, 8 cents wide, 6 cents wide. So obviously the markets are a lot wider and there's much less volume and much less open interest, right? So the reason that we're interested in this case in Apple focusing on the expiration cycles that are the monthly is the liquidity is way superior. In the monthly expiration cycle, we're going to get filled at a better price and we're going to get filled faster, right? And God forbid we have any size in our orders, that really can't be handled much on this weekly expiration cycle. The 180 strike, if let's say we want to trade 100 Apple contracts, well, that entire strike did 71 contracts for the whole day. Again, the liquidity isn't there. And the difference between getting filled at a 2 penny penalty or 2 pennies away from mid-price over the long term is going to add up to be a lot of money, right? So this is an example of Apple. And again, let's take a look at another stock, right? Because Apple is the most liquid product in the world. Let's take a look at a stock that is still liquid, however, not as liquid as Apple. So we look at Netflix, and this time we're going to start with the weekly expiration cycle for Netflix. So to start off, we see pretty wide markets across the board. We see 10 cents, 10 cents, 20 cents, 15 cents, and so on. On the call side, we're seeing 25 cents, 10 cents, 15 cents, 20 cents, 15 cents, 30 cents. So obviously the Netflix weekly expiration cycle, we see very little liquidity at all. On top of that, we see volume in the single digits, right? So again, if you wanted to trade a 10 lot, you would have more volume than everyone else in the market in this expiration cycle for Netflix on that strike. But let's take a look at the monthly expiration cycle, right? We see tighter markets across the board, and we also see volume in the hundreds as opposed to the single digits. And we also see open interest in the thousands or tens of thousands compared to just single digits. So this is why liquidity is so important, and this is how you could tell that there's so much difference. So again, part of this 50-day thing that we're talking about in duration in trade has to do with the monthly expiration cycles. Not only are the probabilities most accurate in the monthly expiration cycles, but again, the two reasons why we care about them the most are number one, we're going to get filled at the best price, and number two, we're going to get filled at that best price at the shortest amount of time. Right? So that is why we're focused on the monthly expiration cycles. But what about this whole nonsense of 50 days, right? So you can see in this photo here, in this image here, we're looking at options prices as time passes, right? So on the x-axis, we're seeing days to expiring. And just so everyone is aware, this line right here is 30 days out, right? 50 days is about here. So as we can see, the rate of theta, which is being shown here, is increasing as we get closer to the option expiring, right? Or the way to think about this is the value that's getting removed from the option every single day is starting to speed up as we get closer to expiration, right? That's what we see here. So you can see really around that 20-day mark, the amount that gets removed from an option every single day, that theta decay, goes up. And again, you can see that by this chart. So we're looking for two things. When we want to think about how many days we want to be looking for these monthly expiration cycles for us to execute all these strategies that we have here in this market hero course, is number one, we know that options are overpriced, right? And we know that the expected move overstates the actual move. Thus, options are overpriced, and we have an edge in selling options in the majority of situations, right? So the first thing that we want to look for to figure out which days to expiration, again in the monthly expiration cycle, is our day, is number one, the win rate over expected. So again, we know that options are overstated. Thus, we win more than we are expected to. But is that the same for 20 days compared to 50 days? Or 30 days compared to 70 days, right? That's what we're looking for, because again, we want to trade in the times where we have the biggest edge. And at the same time, we want to combine those times where we have the greatest edge to ultimately us making the most money per day, right? These two combined are going to be the two things we're looking for to determine which days to expiration is where we want to live. So we did a study from 2003 to present. So in SPY, right, the S&P 500 index ETF, right, whenever we could, we sold the one standard deviation strangle, right, the expected move strangle, the 16 delta call and 16 delta put, when at the same time whenever we could, right? So the trades were placed in the following days to expiration. So 20 days, 30 days, 40 days, 50 days, 60 days, and 70 days. And then what we did was we didn't manage the trades at all. We just held them to expiration, right? So what we did was whenever we could do these, whenever 20 days, 30 days, 40 days lined up for the monthly expiration cycle, we did that. So let's take a look at today and see if we could do that. So right now, the monthly expiration cycle is 11 days. Is 39 days, is 74 days, right? So we couldn't have put on any of these trades today. However, if we did the trade yesterday, the December contract would have been 40 days from expiring. And then if we do this trade 4 days from now, the January monthly expiration cycle will be at 70 days, right? So that's when we will go ahead and execute those. And then once the December contract got down to 30 days, we would do it. And then 20 days, we would do it, and so on and so forth. So that's exactly what we did with this. So it's as many times as we could. Now here are the results. So for starters, again, this trade is supposed to be profitable 68% of the time. And we can see we outperform that on every expiration or every day to expiration. So on 20 days, 30 days, 40 days, 50 days, 60 days, and 70 days, right, we won more than we were supposed to. So again, across the board, selling options works because the expected move is what options are priced off of. And that expected move is overstated on average to the actual move, right? But you can see the 50-day and 60-day to expiration had our highest win rate, right? So that's what we want to focus on. And both of those win rates were better than expected by about 19.12%. So we still saw double-digit percentages better than expected across the board except for 20 days. But still, the 50 days and the 60 days were the highest percentage better than expected. So options are most overstated according to our data from 2003 to present when you're looking out 50 to 60 days. However, the deal breaker here is going to be the P&L per day, right? So if we're looking at that 50-day column, we see we make about $1.49 per day. And if we go out to that 60-day column, while we're still right 81% of the time, which is 19.1% too, better than expected, we only make about $1.36 per day. So if we take our bits of criteria, which is win rate over the expected and P&L per day, it becomes very, very clear that the 50-day window is really our sweet spot because, again, it gives us our highest win rate over expected and it brings us the most money per day. So the reason you're going to see, and you probably have seen so far, that all of our strategies are dependent on that 50-day window is because of those two reasons. Number one, because it gives us our highest win rate over the expected outcome. And number two, it brings us in the most money per day. Take that and marry it with the fact that we're only going to be doing these in the monthly expiration cycles so that we can get filled at the best prices, at the best strikes, and you have a recipe for success. So 50 days out in the monthly expiration cycle is where we live and where you will be living too. I'll see you guys in the next video.